Welcome. You're listening to Mortgage Investing 101, the show where we discuss high yield real estate mortgage backed investment opportunities. I'm Edward Brown, your host, and I'm proud to introduce my co host, Mark Hahn, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. Our goal on this show is to provide information and to increase your awareness of these important alternative investment strategies where you can earn secured high yields using your savings or IRA accounts. Annual yields of 8% or more are not uncommon using these strategies we're going to discuss on today's show. If you like what you hear today, please call Pacific Private Money at 415-883-2150 for more information, or go to pacificprivatemoney.com. You can also go to our website, mortgageinvesting101.com. And for fun, we're also going to have trivia contests at each commercial break, where the first three callers with the correct answer win a free 3-day, 2-night vacation. The vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. And the vacations are free. Lighthouse is only requesting a $75 house cleaning fee. Check them out at lighthouse4fun.com. Today's trivia theme is baseball teams in the movies. Have a little fun with that. Real baseball teams, not like the natural where it was the Knights. Not a real team. These are
real teams.
These are real teams.
Stats.
Okay, so Mark, I know you wanted to start off with comparing the mortgage investments that you provide with what's going on in the stock market, because the stock market's really hot right now.
Well, yeah, and so, by the way, Happy New Year, Edward. And
you too.
Happy New Year, audience. Thank you for listening in on Mortgage Investing 101. You're either listening in for one of two reasons. One, you're, in your car on a Saturday and you're dialing around and you're looking for something interesting to listen to other than music. And hopefully we'll be a little bit, don't say we can compare to maybe old Led Zeppelin tunes or classic rock, but we'll try to do something, talk about something maybe a little bit more important than classic rock, which is classic yields and returns and how to boost the yields you earn on your savings and IRA accounts. But in this new year, the top of the news seems to be how great, quote unquote, the stock market is doing. It's up 26% year over year.
That's not bad.
For calendar year 2013.
So if you invested on January 1st.
Right. So if you had all of your money in cash or other investments and you cashed out on, first week of January and put all of that money into a index fund for the Dow Jones, then right now you'd be sitting pretty. You'd be up 26% and you'd be happy. But let me ask you something. How often does anybody do that? And
1 in a million.
Right, and our year-over-year growth rates in index funds, particularly in equities, where the price goes up and the price goes down, isn't meaningful. And so, I want to, for most people out there who have monies invested in stocks, that's a false euphoria, and it's the media for you. And the media is trying to make it, make everything sound like everything's great. But 26% year over year. You got to look at over the last 5 years. Now, we talk about mortgage investing where over the last 5 years, we've been able to provide for our investors secured returns of 8% or more year over year.
And I think the important thing there, too, is that not only has it been consistent, but from a relative safe standpoint, it's been extremely conservative because it's secured.
Right, and so our investors over the last 5 years on their invested funds have achieved real returns between 40 and 50%.
Yeah, because
total.
Yeah, the reason is because the principal hasn't changed.
Right. So let's compare that to the stock market. So the stock market is up 26% this year. Well, in 2008, it was down 34%.
And if you actually started, then you lost 34% of your money. I mean, you needed to get at least 50% back just to break even.
Well, the year that it lost 50% in 2008, it started out the year at 13,265. That was the index for the Dow Jones. And it ended the year at 16,576. So when you do the math, that's a total 5-year return of 24%. Year over year or annualized, that's 4.8% on a simple interest. On a compounded basis, it's even less than that.
3%, yeah.
So, right. So so you have to kind of look behind the numbers, and I think people all know that. I mean, unless you're just really, ignorant of how finances work, you know that your savings, your IRA accounts, if you look back even further over a 10-year period, if you've been sticking to the traditional investments that are recommended by your broker, which would be presumably a diversified portfolio of stocks, bonds, and mutual funds, and et cetera. Those who've been following that course, more than likely over the last 10 years, have realized some fairly disappointing, average annual year-over-year yields.
Yeah, but Mark, we all know that the stock market's going to go to 25,000 next year, and then that'll.
Well, there are books written about that. I remember Dow Jones. What was Dow Jones 30,000 that was written sometime in 1999,
yeah.
right at the height of the stock bubble, and then
I remember that.
and then we all knew that they're not making any more land, so real estate will continue to go up 20% a year like it was in 2003, 2005. Now, of course, we love real estate here at Mortgage Investing 101 because that's what we use as security for the loans that we make, which is how we provide 8% or more yields to our investors, is because we use your money to fund loans secured by real estate. But here's the thing, we generally only loan on a conservative basis at approximately 70% loan to value or less, and oftentimes less. So we're not exposing ourselves like the banks were in 2007 and 8 when everything started to collapse, when the bubble popped in the real estate market. The banks were exposed at anywhere from 80 to 100% of market value at the time. If you recall, many of you out there will remember that anybody could buy real estate 100% financed. Well, not anybody with a good FICO score and who didn't mind lying on their loan application about their income, the so-called liar loans you'll recall in 2004, 5, and 6. You could buy all the real estate you wanted with very little to nothing down, 100% financed at the top of the market. And the banks were making those loans, and that's how the banks got in trouble. The subprime industry is what brought the real estate market down. Those subprime loans, those that were at the 100% of market value, those ended up being the worthless securities that destroyed the integrity of the secondary mortgage market. Well, us hard money lenders, we never played in that part of the pool, that deep end of the pool. We stayed in the shallow end, and we've been making loans conservatively for over the last 5 years. When we started out, when I got into this business in 2008, as the market was still cratering, we were making loans at 60% loan to value. Then we bumped it up to 65% when it started to look that the prices were stabilizing, that we had hit a bottom right around 2011. And then in 2013, we bumped that rate up to about 70% loan to value, again, as we saw that the markets were actually appreciating. And so we've always been conservative in our lending guidelines. And so our investors have never lost principal. Our investors have always achieved the yield that they've been promised on their investment. And so over the last 5 years, that has been at a minimum of 8% and oftentimes higher than that. So again, that's what we're talking about here at Mortgage Investing 101. Again, if you're just tuning in, I'm Mark Hanf. Edward Brown and I are talking about mortgage-backed investments that return yields of 8% or more, secured by Northern California real estate. And you can find out more information by going to our website, pacificprivatemoney.com, or going to the radio show website where you can listen to previous podcasts at your convenience. That can be found at mortgageinvesting101.com. That's mortgage investing, and then the number is 101.com. There's information on us. And so when you compare mortgage investing to the stock market, I've always looked at the stock market as just a little bit of gambling, if not a lot of gambling.
Legalized gambling, yeah.
And so,
but it's not manipulated.
Oh, of course not. So, I don't know about you, but I don't like to live my life where my returns are really outside of my control.
Exactly. I was just going to say it, outside your control.
And so, if you want to take charge of your IRA accounts and your 401ks and your savings, and you want to look forward to being able to retire in the manner that you envision, in other words, retire successfully, in even other words, retire with an income stream high enough to support a lifestyle that you've always imagined that your retirement would be. If you're like Edward and I mean, we're baby boomers. We were both born right around 1960, and so we're looking ahead at our retirement. And again, we know how expensive it is to live here in the Bay Area. I have not been. I am very happy to say, have not been heavily invested in the stock market over the last 10 years. I have been investing in mortgage-backed investments, and I'm very pleased and glad that I have. And I've got several hundred clients who are clients of Pacific Private Money who are extremely happy that they have stayed out of the stock market and have stayed out of bonds and stayed out of those so-called conservative traditional investments that brokers are pushing.
Yeah, one of the things that I really appreciate about the mortgage-backed investments is it's a nice passive investment where you don't have to worry about looking in the paper every day. Was the market up? Was the market down?
That is so true.
I just don't have the stomach for it anymore.
The news is not your friend. The news media is not there. I mean, it's a business. And, we've all heard the term, if it bleeds, it leads. And I remember there was actually I'm going to tell a little bit of story that's kind of related to this. You just said, I don't want to have to read the paper and care about what is happening in the economy because I don't want, because of the effect that might have on my traditional stock portfolio. When I first got into the real estate business, I've been in real estate for over 30 years, and I come from the real estate development side. And there was a time when the company that I worked for, there was a period of time over about 10 years where they decided, and this was in the 1980s. If you remember in the 1980s, in real estate, commercial real estate, there was a flood of money coming in from Asia, from Japan, that was buying up commercial real estate, and the cap rates were going crazy. It was hard to make money in commercial real estate because of this foreign influx of dollars coming in. So the company that I worked for decided it was going to get into a area of commercial real estate that the traditional monies were staying out of, and that was recreational properties. So we ended up buying some RV parks and campgrounds and marina properties in Northern California, and that was all well and good. But I soon found out that, we didn't really enjoy and benefit from owning property where the weather had an impact on earnings.
Interesting.
So years when it rained on major holidays like Memorial Day weekend, or if you had a lousy weather on 4th of July or Labor Day, you lost money for the year. And so it was a lesson about, you don't want to have investments that are tied to events outside your control. In this case, with recreational properties, bad weather years meant bad profits. And so here with the stock market, it's, how many things affect the stock market?
Well, it could be just world events. I mean, IBM might be a decent company, but suddenly Iran develops nuclear power, and suddenly IBM drops in price. It has nothing to do with it.
It's the psyche.
Yeah,
absolutely.
Tell you what, we're going to cut to our first commercial break here. We're in the studio here with Mark Hanf, the president of Pacific Private Money. He can be reached at 415-883-2150. You can also go to our website, mortgageinvesting101.com, and I'm Edward Brown. All right, here's our first commercial break. First trivia question. Again, the theme is baseball teams in the movies. In the movie Major League, which Major League Baseball team was featured? The first three callers, if I remember correctly, that movie came out in 1989, right around the time I got married. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouseforfun.com. Call 888-529-1134. That's 888-529-1134 to answer this question. In the movie Major League, which Major League Baseball team was featured? 888-529-1134. Make sure to include your name, email address and speak slowly and spell out your email one letter at a time. Don't touch that dial. Mortgage Investing 101 will be right back. Wild thing. You make my heart sing. Remember that?
You make my thing spray.
Yeah.
I only know that line because I heard, I went to a high school talent show one year, and this high school band was playing Wild Thing, and they did that refrain towards the end. Wild Thing, you make my heart sing, you make my thing spring. I'm like, what?
Whoa, yeah.
Like, parents of the audience that were listening were like, oh my God.
2014 gonna be a good year. A good year.
Yeah.
Yeah, he's got something from Jordan. I got something from Jordan. You know, she had two N's in her name.
Yeah, that's why we didn't make it Jordan at Pacific Private Money, because it was just it's spelled so differently. So.
Oh yeah, that's right. She's the only one that. Yeah, good point.
So Mirka's not back yet until next week, and Debbie's in this afternoon, and I'll sit with her again. We already talked about making a spreadsheet for your loans to make sure that you get paid properly. And the first loan, we agreed we weren't going to send you the per diem, and then I guess on the second loan you did get the per diem. So it doesn't really matter, because you in other words, you got to check, because the idea was that if I'm buying into the loans, I don't want it so that you have to actually pay back any of that. I was going to make it kind of, if you're paid in arrears continually, then there'll never be that issue. Anyway, we'll get that in the next few weeks. We'll get that spreadsheet
I just thought it was interesting because you sent a nice package.
Yeah.
And I got it on like the first one and the third one, but not the second one.
Oh, okay.
And that's why I was just thinking that maybe you just, it's.
I don't know why. It's probably, Jordan probably got your email about you don't need to send me the full package on those, but then she went ahead and did it anyway. The third one, I don't really.
Okay. No, it's actually nice to get. I actually do like it.
Yeah.
Okay.
We'll get into a little detail on Mortgage Investing 101.
Exactly.
Talk about the type of loans we make, and a little repetitive, but
it's okay.
Important.
Yeah, because it's funny. I was going to say that the banks seem to be the ones that make the money. Because they're charging the interest and
right.
They're back, but I don't want to. Because that's FDIC stuff. Okay. Ready?
Yep.
Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with my co-host Mark Hanf, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. When we cut to the first commercial break, we asked this first trivia question. Again, the theme is baseball teams in the movies. In the movie Major League, which Major League Baseball team was featured?
Was that the Cleveland Indians?
It was the Cleveland Indians.
So.
Very good.
That was a fun movie.
Yeah, I actually like that movie a lot.
We were just singing Wild Thing in the break there.
Glad
you weren't listening.
Yeah. Hey, people like to hear us sing 10 or 15 miles from here.
Yeah, right.
Okay. So, Mark, the name of the radio show we're doing is called Mortgage Investing 101. And it's kind of interesting. Actually, what I was thinking about was, do you remember the gold rush of 1849, 1850?
Of course, we were around.
We were right. Okay, so if I remember correctly, people went out there just clamoring, trying to get gold, and most people didn't make it. But you know who made a lot of money? Levi Strauss, because he ended up providing the jeans and other equipment to the gold panners. So he made a lot of money, all right? Yeah. And it kind of reminds me, that's sort of like what you do, because the kind of loans that you provide, and I know you'll get into this more detail, but the people out there quote, taking a risk of buying real estate, you're conservatively lending at 60, 70% loan to value. So seem like you're always going to be making the money because you're the bank.
I love that analogy, Edward, and you're absolutely right. Where Levi Strauss made money providing supplies to those 49ers, the original 49ers, we at Pacific Private Money since 2008 have been providing the juice, the leverage, the capital that real estate investors have needed and needed since 2008 to be able to buy, fix, and flip distressed real estate, which has been a huge market since 2008. So one of the outcomes of the whole foreclosure market, the real estate, market meltdown, whatever you want to call it, the bursting of the bubble. What ended up happening is that a tremendous number of homes that had become overvalued, and people who owned and lived in those homes were borrowing against them. Many of them were treating their real estate like an ATM machine and were borrowing and borrowing and borrowing. And then when everything came crashing down and their loans started to adjust, a lot of people decided to stop making their mortgage payments, and or they couldn't afford it because they had pulled cash out over and over again as their values had gone up, and the banks were more than willing to make those loans. And so you had a situation where you had two types of distressed real estate. You had the distressed real estate where people bought at the top of the market or near the top of the market and overpaid for it, and a lot of those guys bought those properties with 100% financing. That was one segment of the market. The other segment of the market were people who lived in their existing home, which may or may not have been in good condition, and and the values of those homes, according to the appraisers, were going up and up and up and up every year, and a lot of people were just, refinancing their home, once or twice or three times a year, continually pulling out equity and doing whatever they wanted to with that money, quite frankly, because there were no strings attached to those refinances. So market starts turning in 2007, 8, 9, we're going down, down, down. Particularly, now I want to talk about the segment of the market of the people who are treating their homes like an ATM. There were hundreds of thousands of homes, and even just in California, where these homes were built in the 40s, 50s, and 60s, and many of these not remodeled. Many of these homes, the homeowners were borrowing against them, taking out these larger and larger loans. All of a sudden now they're underwater, the loans start adjusting, they can't make the mortgage payment, and they end up in foreclosure. And that was really the sad part, probably one of the saddest parts of the real estate meltdown, was those people who lost their homes largely because they made unfortunate economic decisions about refinancing and pulling the equity out of their home. So, but those homes are and have been and are still today opportunities for real estate investors to take distressed property in need of remodeling, in need of updating, and they're buying them either at auction or directly from the bank after the bank forecloses, or nowadays what's more common is via short sale, meaning the homeowner is selling the home at a market price less than what's owed on it. The bank, of course, has to approve it. It's called a short sale, and these are homes that are being bought by the real estate investors and are turning them over. And so that's the market that we're serving. Well, that's the market that we're providing capital to.
Here's the interesting thing here's an easy way to back that up. What are some really well-known shows that are showing up on TV? Flipping Las Vegas, flipping Boston,
flip this house, flip that house.
Yeah, exactly. And so you're one of those guys behind the scenes, actually, potentially providing the capital, but not at 100% loan to value.
Right, we're not. And so here's where what we haven't gotten to. So we're talking about Mortgage Investing 101 and the products that we provide where our investors are able to earn 8% or more on their savings. And if we're providing 8% or more to our investors, obviously we need to be charging more than that to the borrowers. So the question on the minds of a listener might be, are you then saying you're charging 9 and 10% for your money? And I'm going to say yes, absolutely. We absolutely charge 9, 10, 11, sometimes even 12% for the short-term use of our money through Pacific Private Money, located in the Bay Area. We do what's called hard money loans. It's called hard money because the money is largely secured. Well, it's 100% secured by the asset, but it's largely underwritten based on the value of the property, not so much the condition of the borrower. And that's different from what the banks do. And so the reason that we're able to make loans like that is because the banks largely stopped making loans to real estate investors after 2008. That's really the key. The whole industry for private money lending and hard money lending, I use those terms interchangeably, by the way. If you're wondering what's the difference between a hard money loan and a private money loan, there isn't any. It's just, in fact, nowadays we tend to call ourselves private money lenders because it's kind of a softer, easier
It's
term.
like saying Affordable Care Act rather than Obamacare.
Yeah, right. It's just it's a name we prefer because hard money, the old hard money loans from 10, 15, 20 years ago, had a bad reputation for the types of loan sharking and predatory lending that they were accused of. Whereas we're providing capital to real estate investors. And I won't say they're happy to pay 10% for the money, but well, actually, some of them are, because again,
Sure.
it's an opportunity for them to buy, fix, and flip real estate in the Bay Area, for which they are paid well when they do a good job.
If you're the only game in town,
Yeah.
and
Well, and we are.
yeah, and they're able to earn $100,000, they're not going to mind paying you the $10,000 extra.
The cost of capital is part of the cost of doing business. So when a real estate investor, a savvy real estate investor, looks at an opportunity to buy a property, and they're looking at the price they can pay for that property, and they're estimating the budget to remodel it and to flip, there's components. There's several components to that. There's the purchase component, there's the closing costs, there's the remodeling costs, and there's the carrying costs, which include financing. And so a savvy real estate investor, and we make loans to savvy real estate investors at Pacific Private Money, they calculate the cost of financing and the holding costs, including interest on that, in their total budget to buy, fix, hold, and then flip real estate. And there's plenty of room if you're good at what you do. There's plenty of room for the cost of capital. And so again, we provide the opportunity for people to make money in real estate. And why don't they get a bank loan? Because the banks are no longer making those loans. Ask any contractor, rehabber, real estate investor, ask them how many bank loans they've been able to get in the last 5 years. You'll probably hear it's a goose egg. It's a big fat zero. I mean, the banks since 2008 have only been interested in making one type of loan, and that is a consumer home loan to buy a primary residence. We at Pacific Private Money don't specialize in that loan. We do those from time to time under special circumstances, but 95% of the funding that we do at Pacific Private Money are on non-owner occupied investment opportunities to buy, fix, and flip a single-family residence or multifamily residence in Northern California. That's our niche. That's our specialty. That's what we're good at. We have many repeat clients, and again, they're happy to pay the price we charge them. We think we're fair, we're reliable, we're fast, and that's what's very important in this market is reliability and speed. And so we provide both of those things. And again, our investors are enjoying that note yield, minus servicing expenses, which are often which average 8% or higher. And when we say 8%, we're really talking about the lower end of the spectrum. We have beat 8% every single year since 2008.
Yeah, I can attest to that because I'm in your fund and it's paying, 8.9%, I believe was the last.
Yep, we're just about to start working on our fourth quarter returns. We don't quite know what those are yet, but it would surprise me if it weren't in the mid 8% yield, because based on the way we calculate those yields, which we can get into a little bit later. But again, for more information on how you can earn 8% or more with safety and security features that you're not going to find in traditional investments, you need to call us. Our Bay Area phone number is 415-883-2150. That's 415-883-2150. And when you call, there's no hard sell. We're not gonna we're not there to sell you. You're not going to be writing a check to us. You're just looking for information, and we're just looking to provide you with information. This is not for everybody, but we think it's for most people who are looking to diversify their portfolio and add high yield.
There are qualifications.
There are qualifications, and we might as well talk a little bit about that. So
why don't you do that? Go ahead and do that before we cut to the break, because after the break, I want you to get into real examples. Give us the deal of the week and examples of loans that you've recently funded.
So one of our primary investment products at Pacific Private Money is our mortgage pool fund called the Pacific Private Money Fund. In fact, that fund has its own website, which I'll give you right now. It's pacificmoneyfund.com. Again, pacificmoneyfund.com. There's information on our mortgage pool fund, and that fund does have requirements and qualifications for investments. So we are only allowed to take what's known as an accredited investor. So an accredited investor, that's a definition set up by the government, by the SEC, and the current definition of an accredited investor is someone who has a net worth of $1 million or more, not including the equity in your home, your primary residence. So if you own assets outside of your primary residence and they're more than $1 million net, you qualify. The second qualification is, well, actually it's an or. You either are worth more than $1 million or you have earned $200,000 or more the last 2 years. If you're single and if you're married, it's $300,000.
Well, you know, the funny thing about this is that the investments you're providing are very conservative. So I'm not even sure why the SEC puts that high a limitation. I mean, we're not talking about, you know, that this is not available for little old ladies. You know, it's a fairly conservative, very easy to understand investment.
Well, part of this is the fallout from the fallout from the mortgage meltdown, the fallout from what's happened when, well, going all the way back to the internet bubble. It's just the government has been for, you know, the last decade kind of the nanny state mind. You've heard that. So in other words, they're really trying to protect people from themselves, and so the reason to have qualifications for a syndicated fund like the Pacific Private Money Fund is to protect people, to protect the innocent.
Yeah, there you go.
They're trying to be Superman.
Okay, tell you what, we're going to cut to our second commercial break, and again, the theme is baseball teams in the movies. And when we come back, Mark is going to get into real examples so that the audience can understand exactly how mortgage investing works. Now, the theme is baseball teams in the movies. Here's the second commercial trivia question. In the movie Rookie of the Year, I don't remember how many people actually saw that movie, but it was kind of a sort of a little bit of a spoof, kind of a silly kids movie, but it was actually pretty good. Which Major League Baseball team was featured in that movie? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouseforfun.com. I think the movie came out in either the 90s or the 2000s, so it's fairly recent. Call 888-529-1134. That's 888-529-1134 to answer this question. In the movie Rookie of the Year, and if I remember correctly, what ends up happening is a young, like I think he's 12 years old, he breaks his arm, but that makes him so, gets so wound tight that he can throw 100 miles an hour, and that's how he's the Rookie of the Year. He's a young kid. All right, in the movie Rookie of the Year, which Major League Baseball team was featured in that movie? Call 888-529-1134. Make sure to include your name and your email address. Please speak slowly. Spell out your email one letter at a time. Don't touch that dial. Mortgage Investing 101 will be right back. You ever see that movie?
I don't think I did. It's cute.
All right. So we've got 15 minutes.
How much?
Ready? 15 minutes.
Okay.
These are all pretty. Welcome back to Mortgage Investing 101. I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money, one of the fastest growing private mortgage investment firms in Northern California. When we cut to the second commercial break, we asked this trivia question. Again, the theme is baseball teams in the movies. In the movie Rookie of the Year, which Major League Baseball team was featured?
Was that the Milwaukee Brewers?
No, it was the Chicago Cubs.
Oh, okay.
Cute movie. Okay, Mark, we promised to tell the audience not only the deal of the week, but give us real examples of mortgage and loans that you've invested in to give the audience comfort as to how they can earn this 8% return.
Well, you caught me here. Deal of the week. So we just kind of had a 2-week vacation here. So there wasn't
deal of the century. How's that?
Yeah, the deal of the year maybe.
Yeah.
There wasn't a whole lot of activity going on the last 2 weeks. In fact, I enjoyed a little bit of time in Tahoe, even though there wasn't much snow up there. I was up at North Star. They had a little bit of man-made snow going there. It was fun. I had a great time and had a very quiet New Year's celebration. I tend not to go out anymore with all the young crazy people like I used to be back in the day. But in any event, we have started out the New Year strong. I got back to my office and I had like 25 messages from people, many of them looking for loans that they hope to close in early January. So my staff is hard at work. And next week we're looking at actually funding quite a few deals, and so there's one loan in particular I want to talk about, and here's a classic example. So this one is in Novato. This was a short sale situation. The owner of the house is 92 years old. He got into a reverse mortgage, and according to the listing broker, who is very fond of this. Has grown very fond of this older gentleman as he's represented and tried to sell his home for the past year. And turns out, at least the story is, and it's not an uncommon story, the guy got into a reverse mortgage, presumably without understanding, what a reverse mortgage is and how it can impact you over time. And so he's in a situation where he owes now on his home more than the home is worth. And he's unable to continue making payments because of his age, and so he needs to short sell the home. The home was listed originally at $750,000, and it was in contract with a real estate investor who was able to get the banks to agree to a price of $630,000. And so we're making a loan at 70% of that amount, which is in my head real quick. So it's about $450,000 on that. I don't have the numbers in front of me.
441.
Yeah, right, exactly.
Close
So sorry about that. A little brain.
So you're still on vacation.
Yes, I am. I'm mentally still on vacation. So, why we like that loan is, and why it's an opportunity for the investor is that two things. We had it independently appraised, and that appraisal came in at $700,000. So the original listing price was $750,000. The buyers are getting it for $630,000, and so the appraisal came in at $700,000, which make it an effective loan to market value as we see it of our loan of about 63%. So even though it's 70% loan to purchase price, we're at about effective 63% loan to value.
Okay,
and
so that's a pretty safe loan.
Right, and so here's the the rest of the story on this house. The 92-year-old seller of this home was the original buyer of the house in 1967, and everything in the home is original. and he is so proud of how he's taken meticulous care of the house. In fact, in his opinion, which I just think is classic, I met the man personally when I went to visit the house because my office is in Novato, and it was easy for me to drive over there and do a walkthrough.
Sure.
He's so proud of the house, and he's saying, "It's move-in ready. You don't need to do anything."
Oh, it's that sweet.
Which is classic because what's going to happen? This guy is going to go in and completely remodel the house. I mean, all the windows are still original. They're all single pane, so that
now the as-is value is $700 based on the fact that it's from 1967, all original.
Right.
The new buyer, your borrower, how much money is he going to put into it to bring it up to
his
speed?
budget's about $60,000.
Okay, that's not much to bring it up to speed.
It isn't, and so and we predict and project the after repaired value after it's remodeled and brought current, and it's in a very, very nice neighborhood of Novato. it's going to be about $850,000.
Wow.
So, right. So there's it's not a ton of profit in this.
No, but you guys are going to be really well secured if you're only in it for 441,000.
Right. No, we're very well secured. So that's that. And so that's a typical example of what I was talking about earlier, where there are opportunities out there to buy homes that you're not always going to find a home that's still in original condition, but having many of these homes are in dire need of remodel.
Well, let's go back to your borrower for a minute. What are the terms that you're offering him?
This loan we're doing, so 70% of the purchase price is a well-qualified borrower. He's a repeat borrower client, and we're making the loan to him at a note rate of 10.5% for a loan that we're going to write for 12 months, but really he's probably going to pay it off in 6. So
Okay,
it's a short-term loan.
Now, if he's that good a borrower and he's putting that much money into the property, because you're only lending him 70%
Of the
purchase
right.
price, which means he's coming up with about 200,000.
Right.
Why can't he get a bank loan?
Well, again, part of it, 2 reasons. One, I say he's well qualified, but he's well qualified in my opinion on how I underwrite a borrower. And the way I underwrite a borrower is I'm basically looking at the likelihood that this particular borrower can execute the strategy.
Which is putting the 60,000 in, bringing up the speed.
Right, remodeling the home, putting it on the market, selling it, and paying me back. What's the likelihood of that happening? And I look at it differently than a bank does. A bank, every borrower is just a set of numbers. And this particular borrower does not have a high FICO score. In fact, his FICO score is somewhere in the low 600s as a result of being an active real estate investor when the market turned years ago, and he had some foreclosures and short sales. So
I'm going to hit you with a hotspot question. How is he going to be able to make his mortgage payments to you while he's remodeling the house?
he does have reserves, and so as a lot of these guys do, and if he didn't, we would build in an interest reserve into the loan, which we do many times. We will, because oftentimes someone who is buying, fixing, and flipping property, particularly if they're doing multiple properties at the same time, they maybe they don't want to make monthly interest payments. They would rather have that interest either prepaid or maybe paid at the end. I mean, there's a number of ways that we can design the loan for flexibility. And again, it all depends on a number of factors, including the real estate, the loan to value, the borrower, borrower's strength. So we look at a bunch of different conditions when we write the terms of the loan.
Well, here's the funny thing on a situation like that. Not only are you earning 10.5%, but in one respect, not that you would twirl your mustache and put people under railroad tracks, but
like Snidely Whiplash.
Yeah, exactly. That was his name. Yes. Oh no. Is in one respect, you actually would kind of hope that this borrower wouldn't pay you back because you could end up owning that house for $441,000 and you'd make a killing.
Well, you would think so, but in reality, that almost never happens. So we've done 600 loans since 2008. Most of them to real estate investors buying, fixing, and flipping real estate. The other 10% of the loans were for other purposes, but mostly to real estate investors buying, fixing, and flipping. We've only had to foreclose on about a dozen.
And what happened? And how much loss did people?
There was zero loss. There was zero loss of capital. In fact, in every situation, the lenders got everything that they had bargained for in terms of the interest rate that they were promised, etc.
Actually, even more than that, because they probably got late fees.
Several made a small windfall as a result of this. And here we're talking about individual notes, because when I started out in the business, we did not have a mortgage pool fund, and all of the loans that we made were funded by individual investors. That's a practice known as trust deed investing.
And why did you switch to a mortgage pool fund?
Well, we switched to a mortgage pool fund to give the average investor access to this product. The average investor doesn't have access to quality individual notes, and the reason for that is because there's so many people who are out there hunting for them that the individual notes, the the high quality individual notes are going to people who are well heeled, have lots of cash available, and can make their mind up, oftentimes literally within minutes. I mean, that's how fast funding commitments were going in our office prior to us launching the mortgage pool fund. In fact, we still do some individual notes today, but we do them only for a handful of existing investors who we've been working with.
I know in previous shows you've said that this was the best well-kept secret. Doesn't sound like it's a secret anymore.
Well, it isn't, and so a lot of people do like to practice what's called trust deed investing in individual notes. But as I said, that is an industry that used to be the best kept secret in investing circles, and now no longer. So we at Pacific Private Money, we're blessed with great deal flow. In other words, our phones ring off the hook from borrowers and referral partners in the mortgage industry who know that we can make these types of loans quickly and reliably. And so we have great deal flow, and all of those loans, the best loans, they all go to our fund. And so the fund gets the first look at the best loans, and then if our fund is either doesn't have sufficient capital to do that loan, or maybe that loan is not what I would consider fund worthy. And I have individual investors, as I said before, who've been doing this for many, many years, and I will offer certain deals to them that I don't want to put in the fund for various reasons. Maybe it's the type of property, maybe it's a slightly higher loan to value. There's a number of different reasons why we would decide that that's not a loan we want to put in the fund, but I have individual investors who have a more liberal appetite. Let's just put it that way.
Well, remind people who you are and how to get hold of you.
So I am Mark Hanf. I am president and broker of a company we call Pacific Private Money. We are based in Novato in the Bay Area. We have an office in downtown Novato in what I like to call the financial district of Novato because I'm surrounded by the big four. I've got Bank of America and Wells Fargo on one side and Chase and Citibank on the other. I'm right there in between all of them, and
you probably get deals from them.
I do. I get and not only do I get deals from the guys that work in their lending department, but I also get their clients who walk by. They come in and they want to know, because I've got on my window there, earn 8% or more using your savings or IRA accounts.
Well, I can imagine a borrower goes into Bank of America and let's say he doesn't get a loan, and then just walks down the street and says, "Wait a minute, maybe this guy can get me a loan."
No, it's been a great location. And so anyway, you can reach us at 415-883-2150. And again, no hard sell. We're just going to send you information via email, and we do it all the time. We get a steady flow of inquiries about our investment products through our advertising in newspaper and radio and magazines. So again, call 415-883-2150, or you can go to one of our various websites and check us out. We have our primary website is pacificprivatemoney.com. That's pacificprivatemoney.com. But really, you're going to get the best information you're going to get is by calling us and requesting our executive summary on our Pacific Private Money Fund. And so we've got a lot of information that we can provide to you, including a list of our current loan portfolio in the fund and the rates that those loans are yielding. So there's a lot of information you can get, and again, there's no hard sell. You can call and you'll more than likely get to have a conversation with me. I'm the one who tends to have most of the investor conversations with qualified investors.
Yeah, so people who have questions as to how this works, what the risks are, they can just talk to you directly.
Right. And so, and we didn't get a chance to talk about the risks, and how are we doing on time here?
We've got only about 30 seconds.
Okay, well, we're going to have to get into that into another show, or what you can do. Yeah, actually, give us a call, or you can listen to podcasts of our previous shows by going to mortgageinvesting101.com. That's the radio show website, mortgageinvesting101.com. Listen to one of our prior shows.
Excellent. Thank you very much, Mark. Tune in next week to Mortgage Investing 101. We're going to be giving away more free vacations for answering trivia questions and giving more valuable information about mortgage investing. Thanks for listening. I'm your host, Edward Brown, and on behalf of Mortgage Investing 101, so long. We'll catch you next week.